Hello everyone, welcome back to Accounting Made Simple. I'm glad to have you back again with me for lesson 2. In this lesson, we are going to be looking at the basic terms used in accounting. I would like you to put all your mind into it because these are the concepts that are going to make accounting easy for us as we move forward. Before we continue, let's quickly take a look at what we have learned in our last topic. If you have not watched the last video, please do, because that will be the foundation for this class. In our last class, we learned about the definition of accounting. We learned the importance of accounting, and we also learned about the users of accounting information. Now let's continue to lesson 2, the basic terms used in accounting. Let's take a brief look at those terms. We are going to be looking at asset, then we are going to be looking at capital, then we look at expenses, then we are going to be looking at revenue, then we are going to be looking at liabilities, then we'll be looking at profit, then we'll be looking at loss, then we'll be looking at debtors, then we'll be looking at creditors, then we'll be looking at drawings, then after we'll be looking at journal, then after we are going to be looking at ledger, then we are going to be looking at cash flow, then we are going to be looking at bad debts, which will be the last that we are going to be looking at. So let's take them one after the other. The first one, asset. Assets are resources or property owned by a business organization. Examples are land and building, motor vehicle, cash at hand, cash at bank, and so on and so forth. So let's explain it. When we are talking about assets, we mean the properties, resources owned by a business organization. That is, anything owned by a business that you can identify that, okay, this is the property of this business. It can be classified as their asset. Anything that you can see and feel like, okay, let's look for example now. A business that is operating, maybe selling pure water. Surely they will have machines that they will be using to produce the pure water. They will have cars. They will have warehouse that they build, those land and buildings that they have. All these things that they are using for production can be classified as the assets of that business. Also, the business will also need cash to run the business. At least they will pay salary. If they rent where they are using for production, they are going to have to pay for rent and others. So all those things, that cash that they have with them at hand, and the one that they decided to keep in the bank, all contribute to the assets of that business. Now, for us to understand better, for the purpose of this class, let's divide assets into two, which are fixed assets and current assets. Now, let's define fixed assets. Fixed assets are assets that are permanent in nature. That is, they are assets of a business organization that are permanent. You cannot be moving them from one place to another. They are assets of a business that can also last a business for more than 1 year. That is, fixed assets are assets that are owned by a business that they can use for more than a year. Let's look at an example: land and building, plant and machineries. We can see that all these assets that I've mentioned, both land and building, plant and machineries of a business organization, a business can use them for more than a years. Cars they will be using to move their product from one place to another. Chairs, tables, office furnitures, laptops, all these furnitures that I've mentioned, they can last a business for more than a years. Tools and equipment. In fact, this one can last them for 10-15 years if they are well kept. So what we are saying in summary is fixed assets are assets of a business that can last them for more than a year, and most of these assets are permanent in nature. Now let's take a look at the second type of asset, current assets. Current assets are assets that can be converted into cash within 1 year, such as cash at hand, the money owned or held by a business is a current asset. Cash at bank, the money that they keep in the bank, they can go and withdraw it anytime and decided to put it for use of the business. That's a current asset. Stock of goods, the remaining stock that they have not yet sold. Most time, it's usually closing stocks. So it can easily be converted into cash. They can sell the goods and decided that, okay, let me convert it into cash. The next thing we'll be looking at is capital. Capital can be defined as money or assets invested by the owner into the business. It is the owner's claim in the business. What we're trying to say is any money or asset invested by the owner of the business into that business is being referred to as the capital of that business. In case of anything, that capital is what the owners can claim in the business. So the owner did not have any rights to just come into the business and just withdraw money anyhow. The next thing we'll be looking at is liabilities. Liabilities are debts or obligation a business owns to others, such as loan and unpaid bill. Any money or goods or services a business organization owns to maybe its customer or to other business is being referred to as liability. If you take any goods on credit, it is being referred to as liability or for your business. The next thing we'll be looking at is revenue or income. Revenue are money earned from selling goods or providing service. If we sell goods to our customer or we provide service to them, any money being given to us for the service render is being referred to as revenue or income of that business. The next thing we'll be looking at is expenses. Expenses are costs incurred to operate the business. They are money used for day-to-day running of the business, such as rent, salary, and utilities. Expenses are money that are used for day-to-day running of a business. If you are running a business, we are going to pay salaries. We are going to pay workers that are working for us. If we rent where we are working, we are going to pay rent. And we have people working for us daily, we are going to pay wages. Those are expenses. Money used for day-to-day activities of the business are being referred to as expenses of the business. The next thing we'll be looking at is profit. The amount left after subtracting expenses from revenue. After we have subtract our expenses, the total expenses that we used to produce the goods from the revenue, Then the next amount left is profit. Let's look at this example. We have a revenue of 500,000. The cost of goods sold is 200,000. Then the gross profit, that is after we deduct the when we deduct cost of goods sold from revenue, we have 300,000. Then the company make an expenses of 100,000. Then after deduct the expenses, which is 100,000 from 300,000, we have 200,000. That is our net profit. The next thing we'll be looking at is loss. Loss occur when expenses are greater than revenue. When our expenses is more than profit, this will result into loss. We can say that loss occur when a company is spending more than they earn. Let's look at this example for better understanding. A company income or revenue is 500,000. Their cost of goods sold, that is the cost of goods they sold, is 200,000. Then their gross profit is 300,000. That is after deducting 500 from 200. That's how we get our gross profit of 300,000. Then they make an expenses of 400,000. So we can see that after we deduct expenses of 400,000 from 300,000, we are having a loss of 100,000 because our expenses is more than our income. So we make loss. So the next thing we'll be looking at is debtor. A debtor is a person, customer, or a business that owe money to a business because they bought goods or services on credit. Debtor is someone who owns your business money. So anybody that is owing your business money is being referred to as a debtor. Imagine somebody that comes to buy goods from you and did not pay. So you can classify that person as a debtor. It might not be only money, it might even be goods or services. So far they are not paying for the goods or services, they are your debtors. So the next thing we'll be looking at is creditor. A creditor is a person, business, or organization that is owed money by another party called the debtor. Example: if a supplier delivers goods to a business on credit, the supplier is the creditor until the business pay the invoice. As you can see, a debtor and the creditors are one and opposite. Even in preparing account, a debtor is an asset while a creditor is a liability to the organization. The next thing we'll be looking at is drawing. Money or asset the owner take out of the business for personal use. During the time of doing business, the owner decided to take out money or assets or even goods that belongs to the business, decided to take it for his personal use. In accounting, we can call it either cash withdrawal, goods withdrawal, to anyone that you withdraw. So we don't mix business with pleasure in accounting. The next thing we can be looking at is journal. Journal, the book where business transactions are first recorded. Immediately anybody purchase a goods from you, the first book of accounts where you will write that transaction is called journal. It is mainly used for day-to-day recording of transaction. So this is the format. In the format we have date, particular, folio, amount, debit and credit. So we're still going to explain that better during the course of our class. The next thing we'll be looking at is ledger. A ledger, a book or record where transactions are classified into individual accounts. After we have recorded the transaction in the journal, then ledger is the last destination of all book of account. Then we now classify them into individual accounts. That's the format of a ledger being shown. Then the next thing we'll be looking at is cash flow. Cash flow has to do with the movement of cash into and out of the business. That is, cash flow has to do with the way money move in and out of the business. Then the next thing we are going to be looking at is bad debt. Bad debt are amount of money owned by customers or borrowed that are unlikely or impossible to collect because the debtor cannot or will not pay. They are irrecoverable debts. In the process of doing business, there are some people that will purchase goods from you and will not pay. They will mean some people will decided not even to pay back, not because they don't have the money. They have the money, but they will just decided not to pay. So that kind of money are bad debt. Or people that borrow, that collect goods from you that went mad, or that die. There's no way you can collect the money from them. So that kind of money, you call them bad debt in accounting. Thank you for watching. I hope you have learned one or two things. See you next class when we are going to be discussing about accounting equation. Bye bye.